This is the golden question. Hello, guys. Welcome to episode 5 of the Golden Question podcast. Today, we're going to be answering the question, how is the government secretly buying up private property? And now this is a concern that's happening, especially with the new policies of the Fed, with the new quantitative easing that they don't want to admit that they're doing, but essentially it is just quantitative easing. And it's actually a more scarier version of quantitative easing than we saw in 2008 and 2009. I haven't made a video in a while, and I'm sort of established. It took me a while to find ways to upload my podcast onto Spotify and do it in a cost-effective way, because some of these companies are charging too much money, in my opinion, to upload on Spotify and to get your podcast, out there on iTunes and other podcast platforms. But I really want to get it on Spotify because I feel like I can attract a larger audience on there and through iTunes. But I feel like most people are listening to podcasts on Spotify. So again, let's talk about what we are, where we are right now. So again, the bill just passed with Congress, and of course Trump is signing it, and it's essentially a $2 trillion. And again, it's starting off at $2 trillion, but it could expand as we go and as the fees accumulate and all these unexpected costs accumulate. And in that sense, the Fed could just come in again and provide more money. So it's stated as a $2 trillion bill, and it's going to provide. There's a lot of different stuff in the bill that I can make another podcast episode just explaining that. But the main aspects of the bill is providing, Americans with, I think it's $1,200 or $1,300 or $1,400. I think it's $1,200, and then if you're married, and again, it's all dependent on your tax status. So if you're filing joint and you're married, you're gonna get $2,400, and then there's $500 per kid that you have. So again, it's essentially the government directly giving money to the citizens. Now, how is the government going to do this, right? So ideally, in a traditional sense, in the traditional way of the government providing money to the economy, and essentially this is what they're doing. By the government providing money to Americans, it's essentially providing money into the economy. The federal government would have to go through the Federal Reserve. So the Federal Reserve would have to buy up assets, and in most cases, it would buy up assets from the debt issued by the federal government itself, and then the Treasury would print up the currency, print up money, and administer it to the Fed, so that the Fed can then give to the whatever they're getting the debt from, and provide them with the money. So it goes on the cash goes on the assets of the person issuing the debt, and also it goes on an asset on the Federal Reserve, because now the Federal Reserve has that debt instrument on their assets. So it's a cash in terms of the person who's issuing the debt, in which the Fed buys, and now the Fed has the debt on their assets. Okay, so. And what I mean by the debt, I'm talking about the actual instrument, the security. So, slowly, bit by bit, and I'm going to specify a couple of programs that the Fed calls its solutions, the introduction of new Fed solutions that it's introducing. What we're going to see, and what we're seeing, is that the Fed is getting more and more involved into the private equity markets and buying up more and more equity of companies. And And I guess we could start off by just going through a list of some of these programs that the Fed is instituting so that it can hopefully, as they say, make the system better. So the first one is the PDCF, which stands for the Primary Dealer Credit Facility. Okay? And all this is essentially, and I'll read it from the website and then we could expand on it. To support the credit needs of American households and businesses, the Federal Reserve Board on Tuesday announced that it will establish a primary dealer credit facility. The facility will allow primary dealers to support smooth market functioning and facilitate the availability of credit to businesses and households. Again, the availability of credit. It's all about debt. Make sure we get money out there so that all this debt could be bought up really quickly so that interest rates don't rise on the debt, and then soon the debt will become unserviceable. The PDCF will offer overnight and term funding with maturities of up to 90 days. And again, there aren't really any specific rules written that restrict it to 90 days, but it's sort of just like a general outline. Yeah, we'll keep it at 90 days. It will be in place for at least 6 months. Again, at least. And it just says right here, and again, I'm reading this. I didn't get up to this part, but it says it right here. It will be in place for at least 6 months and may be extended as conditions warrant. Essentially, once the fact that it says that, it essentially just means this thing could go on to infinity. So the person, the assets that the Fed is buying, the other the entity that is holding the assets never has to repay the Fed. Essentially, this is what it's saying. Credit extends to the primary dealers on this facility may be collateralized by a broad range of investment grades. Here we go. Debt securities, including commercial paper, which is even more direct to individuals, municipal bonds, and a broad range of equity securities. Again, it doesn't specify which equity securities, but again, it could even be down to the bare bones of just stock. Essentially, it could just be stocks. And again, the interest rates, and here's an important part. The interest rate charged will be the primary credit rate or the discount rate at the Federal Reserve. So the interest rate that they're charging on this is going to be the discount rate. And essentially what they're doing here is they're equating the discount rate and the federal funds rate. So again, the primary dealers are the ones that have availability to trade with the Fed using the federal funds rate, which is obviously significantly lower. Now it's almost at 0%. And unfortunately, banks that are not primary dealers, right, your regular run-of-the-mill banks, your neighborhood banks, they have to go through the discount rate, and they very rarely do because, again, the discount rate is substantially higher. But essentially what's happening right now is the discount rate is being lowered to the point where it's almost identical to the federal funds rate, which means that your neighborhood banks and your primary dealers, which are just big, larger banks that have been accredited and are approved, are essentially at the same level ground. They both have equal access to the Fed's money. So this is even making it even easier for the Fed to push as much money into the economy as possible. And again, here's another program that they're enabling, the MMLF, the money market liquidity funds. Again, it's just the Fed pushing more money into these money markets, in these money markets and these mutual funds. So it says here, the Federal Reserve established a money market mutual fund liquidity facility, or the MMLF, on March 8th. So again, this is new. Now it's going to make the Federal Reserve Bank of Boston, blah, 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 make loans available to eligible financial institutions with high quality assets purchased by financial institutions from money market mutual funds. Money market funds are, yeah, okay. So essentially, again, this is just, and the reason why the Fed's doing this is because, again, these money market funds are supposed to be low risk, right? But you're seeing that the interest rate on these funds are starting to go up. The debt in these funds are starting to increase. And why is that? Because there aren't enough buyers to buy up this debt. So you're seeing the interest rate starting to rise, and these money market funds, which were again in the conventional sense are low risk investments, now are starting to become higher and higher risk. Their interest rates are starting to increase. So obviously the Fed can't allow that. It wants people to just keep on issuing debt and keep on buying debt. So the Fed comes in and has to buy a bunch of this debt to keep the interest rates low and to keep them relatively less risky. And now the next thing, the CPFF, the Commercial Paper Funding Facility. Again, this is just the same thing, which is the Fed being able to buy commercial paper directly from the market. And again, the commercial paper is just an easier way of corporations issuing debt without having to go through the SEC, and it's a lot cheaper. So again, it's definitely in it, but unfortunately, it's going to they have to provide it at a discount. But again, you're seeing the Fed starting to buy these assets as well, commercial paper, and it's what that does is it makes these companies even more inclined to issue debt. Now they don't have to file more paperwork through the SEC. They could just issue debt, and the Fed buys it right away. And the last thing I wanted to say was the FX swaps, which is something that they did institute, but now they're reinstituting again. And all it is doing is essentially the Federal Reserve creating dollars and then exchanging it with other reserve banks around the world for their currencies. What this does is it sort of creates an illusion of more demand of dollars outside the U.S. because the Fed is now pushing more dollars outside the U.S. And again, what is this? This is just inflation. But the Fed is doing this so that it hopefully creates more demand for dollars. But again, there are some ways that this could bite them in the back, because once the Fed issues out these dollars, again, as I've said in previous podcasts, what are these other companies? What are these other countries going to do with these dollars? Right? If they're being thrown these dollars at them, all right, yeah, they like them. There's more demand for dollars. Okay, but what are they going to do with it? If they come back to the United States to look for stuff to buy with these dollars, there's nothing here. And that's the part that they're missing. This could only work theoretically, hypothetically, if the United States produced stuff, produced iPads, produced computers from their own country, in which, okay, now that you've created this money from thin air and then sent it outside, these other countries could, if they realize they want to use their dollars to buy something, if they want the actual good or service, they don't just want the paper, they could come back to the United States and find stuff to buy. But we're just throwing these dollars at them, and there's nothing for them to buy. So soon, this dollars that that's being thrown at them, again, is going to become pointless because they can't do anything with the dollars. And again, we could get into another podcast just talking about that. So essentially, what is the Fed doing in this? The Fed is just creating inflation. It's printing more money. It's giving it to the primary dealers, which are banks that have their own investments, that then use the Fed's money to buy assets from the markets and then quickly sell them back to the Fed, in which now they have a net increase of cash. And again, I'll walk through that one more time. I feel like I rushed through that. So remember, the Fed is printing money. And again, I'm using that term loosely. Obviously, the Treasury is printing money, but essentially, the Fed is just having is just increasing the balance in its balance sheets. So the Fed, it has the cash. It gives it to these primary dealers, and in this case, it's giving it to non-primary dealers as well, again, because they both have the same rates. So again, the Fed says, all right, you have to pay me back, but it's almost non-existent, that rule, because the Fed is charging them almost 0% interest, and they have the ability to roll over that debt an infinite amount of time. So it's essentially, it doesn't matter about what the actual primary dealers have to owe, because they're not given a requirement for when to pay back the money, and they're being received the money at almost 0% interest. So it's essentially them giving the money for nothing in return. So the Fed is providing the funds to the primary dealers. The primary dealers then use this money to buy up assets in the market, right? Because if the Fed didn't provide these primary dealers with the funds, these assets would have no buyers. Nobody's buying up this debt, which is the whole point of the Fed providing these dealers to buy up those assets. If nobody buys up the assets, the price of the assets go down. The price of stocks go down. The stock market goes down. The bond market goes down. The real estate market goes down. But the Fed can't let that happen. It has to keep the illusion that the economy is doing well. So it prints more. It gets the money, prints it, gives it to these primary dealers, so that the primary dealers could then go and buy up those assets. And the only reason why the primary dealers are inclined to buy up those assets is because, guess what? They could then sell those assets back to the Fed. So again, the Fed gives money to the primary dealers. The primary dealers are given the cash and then they say, all right, let's buy up some assets. They buy up the assets, and then they just sell them back to the Fed. So now, again, the primary dealers have a net increase of money, net increase. So there's more dollars out there now, and there's more dollars into the security markets, which is causing prices of these assets increase. So again, what we're seeing here is that nobody's buying up these debt. People don't have the funds anymore to buy up this debt, to buy up stocks, to buy up all this debt, and even again, stocks are not debt, but to buy up all these securities, and then causing the price of all these assets to increase, which again, it's all an illusion to show that the economy is doing well, right? Because these assets are increasing, your average American is going to say, you know what, or even the average investor around the world is going to say, you know what, these assets are increasing, which means that there are a lot of buyers. Those buyers have a lot of money, which means that they have sustainable jobs, etc. But what they don't realize is what's pushing up these asset prices is just money being printed from the Fed. And that's why they call it funny money. That's why they call it cheap money. It's not money actually being created through the economy, through the creation of goods and services. So again, you have to have the creation of goods and services first, then the creation of money follows, and then you have the increase in asset prices. But again, the creation of goods and services is the hard part. When you're lazy, you don't want to create goods and services. You just want the money so that you can cause asset prices to increase. So again, it's all an illusion. It's all an illusion. But again, now I'm going to get to the part. Again, that whole thing sort of was just an introduction. I want to get into now the part of how the Fed, by doing these asset buying programs, is slowly gaining shares and equity from companies. Because if you think about it, when these primary dealers buy up this debt from the companies, they sort of own a portion of the company. And also specifically stocks, right? When you buy stock in a company, you own a portion of the company. So when you have these primary dealers buying up portions of these companies, now these primary dealers own a portion of this company. And again, that's sort of the consequence of issuing an excessive amount of common stock, is you're allowing these investors to own more and more of your company. Now, it could be good to increase your, obviously to increase funds, but the negative consequence of issuing common stock is that now a portion of your company is being owned by somebody else and you're losing 100% ownership. So again, there's different cons and pros to debt and stock. Obviously, debt is worse because not only are you giving up ownership in the event that you go bankrupt, then you have to issue portions of your company to your creditors, but also when you're issuing debt, you're paying interest on it. With common stock, you don't have to. There is no interest. You're essentially getting the money for free, and the only small downside is that the person owns a little bit of your company. But again, you could easily uh, go private again and buy back your stock. Okay, so issuing common stock is obviously less risky for the business than issuing debt. But the problem is, in this case, when the government is being the primary buyer, and again, as I said, the primary dealers, what do they do with these assets that they've now purchased? They're selling them to the Fed. So now the Fed has ownership of these assets. You're seeing there are less and less buyers in the market, right? The sellers are there to sell portions of their assets, and I'm speaking from the perspective of the company. But now you have the Federal Reserve buying up these assets, slowly buying up more and more assets. And again, the Fed is just monetizing debt also for the Federal Reserve. So the Federal Reserve and the U.S. government are essentially working in tandem here to buy up more and more assets and from the private sector. And this is sort of, in a way, nationalizing industries, right? When you think of nationalizing industries, what is essentially happening? The government goes up to an industry and says, you know what, this is now going to become federal property, and now the federal government gives money to these companies, and then the government takes these companies' assets. That's the definition of nationalizing an industry, because the federal government is becoming the buyer. Now, what you're seeing in this case is it's sort of the same thing. Except instead of the government directly buying these assets, it's doing it through the Federal Reserve and through these primary dealers and through the Treasury being able to create money out of thin air and provide the funds to the Fed. And essentially, again, the Fed demanding for these funds to be created out of thin air. So this is, again, very dangerous. It's sort of a backdoor way for the federal government to nationalize industries, and it can get into some slippery slopes. Well, first of all, the very aspect of the federal government being able to buy a private property is sort of without actually, like, let's say the federal government wants to build wants to expand a federal building, let's say in Washington, D.C., it wants to expand something. In that sense, all right, the federal government could buy up assets and then increase its headquarters, for example, right? The building. But in that sense, the federal government is using the funds to directly commit to something that's directly associated with the acquiring of the asset. But in this case, the federal government is just buying up these assets, buying up portions of these companies. And again, nothing's really changing. It's buying up these companies. And soon, if you think about it, right, when a private individual buys up portions of a company, they have a greater say in what the company does. So if I own, let's say, greater than 30%, I get to take some of their profits. I get to claim some of their net income. I get to claim some of their dividends. I might have seats in the board. But now the federal government might be a majority owner in these companies, and soon the federal government now can have a say in what these companies do, right? Oh, you're not paying your workers enough. Pay your workers more. Well, we don't have the funds to pay our workers. Well, we could just print the money and we'll give you the funds. So you're seeing a huge slope that's getting slippier by the year once we see the Fed institute more of these policies And again, this is the problem with the Federal Reserve, is that this was inevitable, right? And unfortunately, fortunately, our early founders didn't see this, and obviously the idea of a central bank wasn't even a thought. But essentially, the reason why this was a reason for our founding fathers to just completely let the government outside of the economy, because then you get into all these different complexities in the economy that now the federal government has to manage, and it's impossible, right? The economy is an extremely complex system. It's not something simple, right? And when you look at the government tends to do simple actions, right? When it comes to the military, it's a simple action. It's just kill your enemy, right? There's nothing complex about it. But once it comes to creating goods and services, administering goods and services, providing salaries, and the whole financial markets, it's an extremely complex system. And I would say one of the most complex systems that that humanity has ever created is our economic system. And with that goes all the different subsystems in that, right? The healthcare, education, because they're all economic systems at core. So letting the government control that it logistically can't, because essentially when you say let the government control it, the opposite of that is let the private sector control it, which is what is being controlled by the economy, the private sector, which is just everybody, right? A lot of people think that capitalism is a system, but the definition of capitalism should be a lack of a system, because there are no designated parties controlling certain things. So when you have the government trying to control aspects of the economy, it's obviously doing it in a smaller, it's obviously going to control the economy with less parties in the economy. If you let it to the market to control it, everybody's contributing to controlling the economy. But when you let the government, it's obviously going to be a smaller set of individuals who are controlling the economy. And obviously, would you rather have 2 individuals control the economy or 20 individuals? The more individuals you have controlling the economy, the better. So again, I got in a little rant at the end. And I guess, again, a lot of these stuff I could make their own individual podcasts, but again, I wanted to summarize today on how the Fed is slowly taking over private property without anybody knowing. There are a couple of people that know, but there's many that are oblivious to this. And they don't realize that not only is the Fed printing money out of thin air, which reduces the value of people's savings, not only is the Fed doing that, but the Fed is now also contributing to the acquisition of private property, essentially, is what it is. It's private property, because these companies are private entities that are now being owned up by the state, by a public entity. So now these private companies are slowly starting to become public. The more the government owns these companies, the more public they are. And soon, there might be a majority public in which the public now has a say in the company. So that's the wrap for today's episode. I know it got really long, but hopefully this sort of touches up on certain aspects of the Fed's operations. And again, this is the layman guy, right? I don't know 100%. I don't know a lot of the individual aspects of it, but you don't need to, right? People say, oh, don't even think about what the government does because it's too complex for you. You're not going to understand it, therefore just let it be. But that when you look at it from a common sense level, a lot of this stuff should make sense. Common sense. It should agree to the rules of supply and demand, the rules of economics. And if it doesn't agree to those rules, then anybody could realize it doesn't agree to those rules. So that's it. I hope you guys enjoyed this long podcast. If there's anything that I said incorrect, or if there's any additions that you would like to make, leave it in the comments below. For people listening, and I will soon get this on Spotify and all the other podcast players. Again, you could visit my YouTube channel. It's The Golden Question, and you could go to your video for whatever episode this is that you're listening to, and then you could comment on that, and I'll read every comment as far as now. Thanks for listening, and stay safe.